Okay, good afternoon and welcome back everyone to our market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today I am joined by Chris Thom from Odlum Brown. He's going to be joining me in talking a little bit about the broader markets, and we're going to discuss how we utilize options in our portfolio. So before we get started, I just want to say a big thank you to Chris for joining us today. Chris, thank you so much for taking the time out this afternoon.
Yeah, thanks for having me. Looking forward to it.
Great. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, before we get into what we're going to discuss here today, I do want to give Chris a bit of time to introduce himself and his firm. So Chris, why don't you just give us a little background as to, what is it that you do and what your firm provides in terms of services?
Yeah, perfect. Thanks, Tony. Yeah, for anybody who hasn't been to any of the presentations that I've done before or hasn't heard of Odlum Brown, we've been in business since 1923. We've got about $16 billion under management. We're completely independent. So what that means is we're not bank owned or bank affiliated. We're an employee owned firm. You actually have to be an active employee at the firm in order to have any ownership in the company. So that's something that we're pretty proud of. We're totally client focused, which means we don't do any corporate finance. We don't raise money from people. We don't do IPOs. All we do is manage money for clients. We've got 6 offices around BC, but we do operate nationwide. So just like I'm sure many of you are not in British Columbia where I am, I've got clients all over the country. So a bit about myself, been working at Odlum Brown in the business since 2008. I do have a derivatives market specialist designation, which is not something that's widely held across Canada. I've been on BNN a number of times and have done numerous TMX events, a lot more virtually now than in the past. As a portfolio manager, I implement the day-to-day operations for accounts. So I work with clients to decide on the strategies that we're going to implement. And then when it comes to actually doing the trades and putting things into action, I'm the one who does it. And one thing that everybody knows about me with options is I'm always trying to really simplify options trading. And obviously, it's an area that can be have a little bit of mystique put around it and seem a lot more complicated. But when things are complicated, people won't use them. So I try to really simplify things so people will actually use options as part of their overall strategy.
Yeah, thank you so much, Chris. And for those of you that joined us for our Options Education Day last year, Chris was actually one of the speakers who came on. He spoke about cover calls and cash secured puts, which are, 2 of the strategies one of the strategies we're going to talk about here today. And we're really going to try to talk a little bit about the broader markets, give you some context into how we're thinking about the broader markets, especially with the volatility here over the past few weeks, and how we might potentially utilize some option strategies in this type of market environment. So that's what Chris and I are going to discuss here today. But the primary question that I want to help investors answer from today's session is really an understanding as to how do we leverage options in this current market environment? What are the types of option strategies Chris and I may deploy for this current market environment that we're looking at, and how we're going to look at those types of option strategies. So today, that's what we're going to go through. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my technical research, and I want to bring Chris in to give his thoughts around what his views with the broader markets are, the type of rotation we're starting to see here, whether we believe that this is the start of a sell-off or this is more of an opportunity to look for some exposure in the broader markets. So Chris and I will have a discussion around that, and then talk a little bit about best practices for the option trading strategies that we're going to discuss here today. We're going to give you a little bit of a feedback as far as, perhaps how we differ in how we utilize options in our portfolio. So really looking forward to all of that. But I think, Chris, the big headline here for everyone over the past few weeks has really been the surge in interest rates, whether you're trading on the US markets or in the Canadian markets. I have a chart here of the 10-year yield for Canadian bonds. From my perspective as a technical analyst, one of the major levels that correspond also here in the US side is really just the movement we've seen in rates. The movement we've seen in rates went from about, for the Canadian bonds, about 260 basis points down to about 42 basis points. And now we've retraced exactly 50% of that, which was the 151 basis points. So just shy of just about 150 basis points. And that's really where we look on the daily chart. That's where the rates have settled around this 150 basis point level here. So this recent surge has really, restructured as far as how we view equities, because from my perspective, on all measures, when we look at traditional metric valuation metrics like PE ratio, price to book, price to sales, most equities look quite expensive here, with the exception of the yields that equities were providing in comparison to fixed income products, especially treasuries. And this has shifted that picture quite a bit. So Chris, I'd love to hear your thoughts a little bit about what has changed over the past few weeks with respect to rates, and how does that impact your views on equities?
Yeah, so I mean, we definitely have seen a spike in yields compared to a couple of weeks ago. But I think if we take a look, if that chart were to pull out, you were to take a look at where those rates are compared to 5 years ago, 10 years ago, rates are still incredibly low. And the yields on a lot of stocks that haven't really participated in the overall rally are still incredibly attractive compared to that. So, I don't think anybody was predicting rates would go down near zero and then just flatline at that level. We're going to see some volatility in yields as well as in the equity markets. But I think in general, if you've got a 10-year bond yield that's yielding around 1.5%, there's going to still be a desire or a reach for yield amongst market participants for some equities that have what would be deemed to be, pretty secure dividends that can offer significantly more on the income side. So I would say, even though we've seen this uptick in rates, I don't think that we had necessarily seen a full rotation in away from fixed income into equities that were able to offer a better yield. So not going to make a call on interest rates, but I kind of don't think that this recent spike makes a lot of these dividend paying stocks less attractive.
Right. But would you agree that it certainly makes some of the high beta, high growth tech stocks look far less attractive, especially when we factor into the fact that when we're discounting cash flows, this 100 basis point move does impact that quite a bit. And that's really what we have seen from equity markets, right? The rotation, and I really, I wouldn't call what we're seeing in terms of volatility over the past few weeks a sell-off per se. I really think it's more of a rotation out of these high beta sectors, because the broader markets, whether you're looking at XIU or S&P 500, those have held up very well through this.
Yeah, for sure. I guess when I first looked at this chart, I was thinking about the rotation away from fixed income towards equities, towards those higher dividend paying equities. I think that we have not seen that full rotation in that yet, but for sure, if we look at market performance over the last couple of years, it's been driven by these mega cap, mostly technology names, where investors were focused on growth and really left a lot of high quality, dividend paying stocks, just kind of left them behind. And yeah, when you start to see rates ticking a little bit higher, opportunity costs start rising. We've seen it in the last few weeks, a pretty significant rotation away from what really drove the market higher over the last couple of years towards some, I guess, I try not to call them boring, because you don't want to buy things that are boring. I mean, I think we'll call them less exciting names that just have really steady businesses.
Right. And Canada, XIU, TSX 60 at new all-time highs here today. Unlike the S&P 500 failing to break the new highs, Dow Jones did make a new high here today, but NASDAQ down 7-8% from the peak even just a few weeks ago here from mid-February. Thoughts on the outperformance that we're starting to see here from Canada, which has largely been an underperformer for quite some time?
Yeah, I mean, I think I've been in the business, 13 years, and I think the whole time that I've been in the business, people have always talked about the TSX, how it's an under-diversified portfolio. So much of it is weighted into materials and energy, and then, on maybe call that on the more speculative side, and then a huge amount in pipelines, utilities, telcos, and banks. And so it's always been kind of an under-diversified portfolio. Well, whereas people would look at the S&P 500 as being, well, this is a well-balanced portfolio. You've got exposure to healthcare, things you just don't have in Canada, or technology, where we've got pretty limited exposure. Other than Spotify being, or not Shopify being the biggest company in Canada, but it's just one name. And so what we've seen now is, because that huge weighting in technology in the US, it's about 25 or 30% of the S&P 500 is made up of technology. So it's actually shifted into the realm of being a horribly under-diversified portfolio with too much exposure to one sector. And that one sector, which drove all of the performance for the last couple of years, has been fading a little bit. Energy has been a big component of market, been a sector that's done very well, and the S&P 500 has pretty limited weighting in energy. So if we see shifting away from some of these growthier names that you were talking about before, towards some of these banks, telcos, pipelines, utilities, it's going to have a much greater effect on the TSX than it will on the S&P 500.
Right, exactly. And here's a chart of the QQQ, which is the NASDAQ 100 index. As we see, this is the rotation that I'm referring to. It's actually quite rare, I would say, that we see the NASDAQ 100 down 7-8% from its peak and still see the Dow making new all-time highs, seeing TSX up, making new all-time highs. This is a rare occurrence that we're seeing that, but this is what leads me to believe that what we're seeing here is purely just the rotation. It is by no means a market top, as we started to feel like, we're getting there over the past couple of weeks. But as we see this rotation just being fairly contained to this one sector, and then seeing energy, seeing financials continue to outperform and break to new all-time highs, materials made a new all-time highs here today as well. That really, again, for me, is the confidence that I need to believe that this is just a rotation and not a major sell-off here for the broader markets.
Yeah, I'd agree with that completely. There's a lot of names that just didn't participate in the rally. I mean, we would, see the index moving higher. But if you actually looked at a broad base of stocks, a lot of them weren't moving. And now if we start to see money shifting from the mega cap names to other areas, then you're going to start to see things. You'll see the index stay around the same levels, but a lot of really good performing stocks within that.
Right. And we've also seen the VIX pull back quite a bit here over the past few trading sessions, back down to the 22.5 level here. This was taken earlier today. Do you use the VIX, when you're thinking about when you're in your option strategies, what do you think about the current levels that we're seeing in terms of, does that influence the type of option strategies you deploy for your portfolios?
Yeah, so I guess I use the VIX as a bit of a yardstick on it's obviously, for everybody, the VIX is a measure of 30-day volatility on the S&P 500. And so I can use that as a bit of a yardstick as far as if the implied volatility on some options that I'm looking at are above where the VIX is, then I feel like I'm getting rewarded for looking at something that's not just the overall index. And those would lean more towards options that I'm looking to sell. If you're looking at something, the implied volatility is 40, but the market's been tanking and the VIX is at 50. Well, are you actually being compensated for the risk that's out there? So I'll use the VIX as a bit of a yardstick for valuing relative value of options, or expensiveness, or if you want to use that, if that's even a real word, of options. But yeah, I mean, I think here we are with the market near an all-time high, and yet the VIX is still over 20. I mean, 20 is what always gets looked at as the long-term average. But that's normally made up of really long periods of time below 20, and then short periods where it's well above 20. But here we are with the market actually pricing options just around the average, or slightly above the average, which without big declines. And so I think that's a contributing factor. That is the rotation that you're seeing out of the bigger names, where option prices will be rising. But also, I mean, some of the things we've seen, some of the anomalies we've seen in things like GameStop, and just attracting more people to the options market. I mean, the options market between, sort of 2010, 11, 12 was a really great place to be selling options. In the next 7 or 8 years, we just saw this compression in volatility that just made it more and more and more difficult to find good opportunities as an option seller. But now, since we've seen volatility in the market for the last year and a half and a bit more interest in the option market, there's better opportunities now than we've seen for a decade. I mean, it's actually a pretty exciting time to be trading options. I mean, I try not to get too excited here, but it's for something that we're looking at all day, every day. Seeing more volatility and higher implied vols in options is something that's really exciting to me.
Yeah, so I actually refer to, obviously, this huge spike that we see here in the VIX, that was the pandemic. I refer to what we consider pre and post pandemic volatility regimes. Before the pandemic, we really had, as you said, a tightening, a compression of volatility within this 12 to 22 range, if you will, volatility, mostly pooling around or clustering around here at the bottom of this range in the low teens here. Since then, we've had this shift in volatility regime, and multiple times we were looking at this to see, are we going back to the old volatility regime? So far, we have not. We've been able to hold this 2022 level here on the VIX. If you're using, the NASDAQ 100, you're even talking about higher volatility here in the 25, 29 range here. So it still remains, despite volatility being on the lower end of the post-pandemic volatility regime. Right now, volatility still remains fairly elevated. A lot of opportunity to collect premium from selling cover calls, selling cash secured puts, even selling credit spreads for those of you that don't prefer to own or want to own those underlying stocks. So thank you so much for your insights there. So I do want to talk a little bit about sector rotation, right? Because we're talking about a lot about rotation specifically within the segments of the market, but then there's also a lot of rotation that we continue to see within the sector. So this is a relative rotation chart of the major S&P TSX in sectors. And the one thing that I want to also point out here is when we see the rotation that we're seeing out of technology into some of these other segments of the market, that's generally healthy, right? We don't want to see a rally where just one or two segments like mega caps continue to outperform and everything else gets left behind. We also don't want to see sectors continuing to outperform where everything else gets left behind, because that's sort of what we saw back in January of 2020, right before the pandemic. It was just technology and consumer discretionary leading everything higher, while the other 9 or 10 sectors were just being left behind in the dust. The rotation is really healthy for a market rally, and that's exactly what we're seeing right now, is a bit of rotation. I know there were a couple of sectors that you wanted to talk about, like utilities, but I just want to point out here, energy being one of the strong leaders of the market right now, starting to slow down a little bit in terms of its strength, but utilities starting to see a bit of rotation here in utilities higher. So Chris, what sectors are you paying attention to right now these days from a rotation perspective?
Yeah, so like you said, utilities is something that I'm pretty excited about. I think that these are businesses that have, I'll just come right out and use Fortis as the example. So Fortis is a company that I know we've got a slide on it later, but 98% of their business is a regulated utility. They've increased their dividend 47 years in a row. Currently, they pay $2.02 in a dividend. The stock has had a good, strong couple days here. It was actually below $50 a few days ago, but now it's sitting around 52 and change. So at those levels, it's still yielding around 4%. 5-year debt on the same company is yielding around 1%, one and a bit. So the big rotation that we're anticipating is going to be money moving towards these utilities that need to generate a return. If a person has enough money to be comfortable, they can decide, I'm going to take this year off of investing. I'm going to just keep what I've got, protect my principal, and not worry about it. But when you look at the biggest asset managers out there, these are endowments, these are pension funds, these are balanced mutual funds, where as a portfolio manager, these people can't be going to the boards and saying, hey, look, we're just going to own a bunch of bonds, and not too concerned about inflation or generating a return. They can't do that. And so for these types of managers that have huge allocations towards fixed income, it's pretty conceivable that there will be a shift away from a portion of it from fixed income towards some equities. And so the equities that I'm anticipating that they're going to be stepping into is not going to be the energy names or commodity related names or businesses that are reliant on the price of an underlying commodity or technology names or multiple expansion. It's going to be some of these names that it's like, hey, revenues are going to be there through good times and bad. And companies like Fortis are a perfect example. I mean, if that stock continues to raise its dividend, which they've said that they're going to be increasing their capital spend by 6% a year, I mean, that's the kind of business that I think a lot of people will want to own and just hasn't been bid up to this point.
I think you bring up a very good point, and that is just the and you what I really want to bring this back to is the first point that you made is despite the sharp rise in yields we've seen over the past few months, we're still a far cry away from where we were 10, 20, 30 years ago. Where I had the chart here before of Canadian 10-year yields, if we go back 1986, we were in the 10% range, right? So despite the fact that we've had about 100 basis point move here, that's still in the grand scheme of things pretty low on the interest rate perspective. And this decline, this sharp decline we've seen in interest rates over the past 30 years, that's created this giant bond rally. Then the question is whether this bond rally is coming to an end. And the as you say, endowments, pension funds, they're moving potentially away from having as much fixed income exposure to having more equity exposure in order to capture the same type of returns that they used to. So I really like this concept of looking at some of these utilities, some of these less boring names. I'm looking at quite a few of the names within real estate right now, looking at some of the names that are outperforming within the real estate sector. Very similar trade to what you're looking at here, but on the U.S. markets within real estate. You also wanted to take a look at financials as well, right? Could you give us some thoughts as to why you're looking at the financials right now?
Yeah, I mean, I guess obviously real estate in Canada has just continued to defy everybody's expectation. I think if we were to look 12 months ago, and you were to poll a group of 100 people where they thought real estate would be at a year later, I don't think anybody would have predicted things would have gone how they are. But the banks, the telcos, all these things are an environment in Canada where they've just got these oligopolies, right? I mean, there's not a true market as far. I mean, they're able to generate better returns than they might be able to in a more competitive marketplace. But if you look at the valuations on the Canadian banks, I mean, as a whole, they're still, even though they've had a bit of a move higher in recent weeks, they're still trading in the low teens as far as PE multiples. So they're priced as if there's some kind of a disaster coming, and yet the operating environment is actually fantastic. The other thing is, the first chart where we talked about how 10-year yields have gone higher, the borrow short and lend long, an upward sloping yield curve is something that the financials benefit from. And central banks everywhere have committed to keeping rates low and where they control them, and that's on the short end. So I think if we see rates moving higher, that at the end of the day tends to be beneficial for banks and their core business. So I think with the majority of the riskiest loans that a lot of the Canadian banks have on the books being covered by insurance, I think the banks are a pretty good place to be within a portfolio.
Yeah, I completely agree. I think you have quite a few things on your side. As far as from my perspective, just purely on the technical perspective, you have strong relative strength here from the financials. Financials continue to outperform here. Here's where financials are within the rotation, still in the leading category, haven't quite pulled down yet, like as we've seen here in energy over the past 4 or 5 days. Financials remains fairly strong here on a relative strength perspective compared to the broader markets. And you have the fundamental factors that Chris was referring to. Those are the reasons that I particularly like the banks, the relatively low valuations, whether you look across Canada or in the US, we're seeing that across the board. The rise in rates, the steepening of the rate curve, of the yield curve, these are all supportive of banks. And the last part is really the economic recovery. We continue to see economic indicators come surprising us to the upside, whether it's employment numbers. And so these are all reasons why these are the types of companies that will generally do better in that type of environment. So, Chris, I think you wanted to take a look at Royal Bank of Canada. Royal Bank of Canada today breaking out to a new all-time high after breaking out above this $82 resistance level, which has been a major resistance level for multiple years for this particular stock. Struggled multiple times at this level, but finally broke out higher here, and even today broke out above this $90 double top here that formed here just from a couple of days ago, breaking out higher here. So from a timing perspective, this looks fairly attractive for a move higher here for Royal.
Yeah, I mean, Royal, like I said, most of the Canadian banks, I mean, their businesses are similar. They're in the same operating environment. Royal is the biggest. They do have access to little bit more exposure than some of the other banks. But so, I mean, I guess there's nothing in particular that I want to focus on with Royal that sets it apart from the other banks other than its size and its scale. And if we do take a look at any options on it, the liquidity is good as well. So yeah, I mean, these banks have been puzzlingly inexpensive for quite some time. And if there was ever a time over the last year where it was like, okay, maybe the real estate market in Canada, which has been pretty untouchable for a long time, maybe there's going to be something with a worldwide pandemic, and things just kept going. So I think in general, having a decent weighting towards the banks, with Royal being a part of that, is a good idea.
Right. So, and I'm glad that you brought up the fact that you're looking at Royal simply as a proxy for the banks, and more so because of the liquidity around it and the ability to execute trades on it. Because Keith did have a question about liquidity. We're going to come back to your question, Keith, in a little bit once we talk a little bit about options, because I do want to talk to Chris a little bit about how he deals with some of the spreads and when he's trading options here in Canada. So, Chris, let's jump a little bit over to the options side, right? Because we want to talk a little bit about best practices for options, whether you're looking at some of these opportunities we're pointing out as opportunities where you want to gain some long exposure through the underlying stock or some long exposure in general, or if you're looking, perhaps you already own some of these stocks and you might want to generate some income. So let's talk through two strategies. Let's talk about buying calls and let's talk about selling cover calls. Now, for most investors here on this webinar, most of you are familiar with buying a simple call option here. It's a strategy that gives you unlimited upside if you are correct on the directional view, with limited risk to the downside, and the risk is limited to how much you pay for the call option. And we usually talk about call options as a bullish strategy, but I always say as a strategist, that's not a fair and accurate statement just to call call options bullish, because you have to also account for the fact that you have to pay for that call option and you have to overcome the cost of that call option. So I call it bullish by a certain amount, meaning you have to understand what your break-even cost is on that option and decide, do I think the stock's going to exceed that break-even price before you go out and buy a call option? And I want to make that very clear for investors, because I think that's probably the hardest lesson to learn as a first-time options trader, is understanding that amount that you have to overcome, the time decay factor that works into the call option. So, Chris, thoughts around just generally, when do you use call options, and what do you look for when you're thinking about buying a call option on a stock that you like?
Yeah, so I guess I'll kind of go add to what you said here about, buying, how, you need to, I'm more of a seller of options. I mean, there are
Mhm.
definitely times if an option is really cheap or something's been really beaten up, and I think, look, there's going to be a short-term move in the other side, the other direction. That's about the only time that I'll take a look at buying. We were talking about using the VIX as a proxy. If the VIX is 22, but I can buy some calls on something that are, a 12 implied vol, then that's something I might look at. The challenge with it, obviously, we know investing is difficult. It's difficult to make money. And so if you're just buying stocks, you need to buy low and then sell high or collect dividends. But you've got holding power. When you're buying call options, it's a lot trickier because you need to get the direction right, the timing right, and the amplitude right. So you need to be right on three fronts. And so that's where buying calls can be a lot more difficult. So, I mean, the number one thing I'd say, if you're going to be buying some calls, really make sure you've got a lot of conviction in what you're buying, and try to not spend very much money. On the other side of selling calls is, that's when options are a little bit more expensive, is when I'll look to be selling some calls. So whether it's a simple covered call strategy, or if you're looking at adding some leverage by using a 1x2 call spread. So that's a situation where I'm going to be adding some upside to a trade that I'm doing, but I'm buying one option and then selling two options against it. So you're able to get that upside exposure by still being a net seller of options. So you're letting somebody else give you more premium or more time value than you're giving to somebody else. So that's, I know I went off on a little bit of a tangent there, but.
So, Chris, I'm going to hold you off on 1 second before we get into option selling, because that's really one of the things that I want to instill on our viewers here. Whenever I bring on another practitioner of options, especially on the buy side or on the institutional side, the overwhelming majority of professional investors will say that they rarely buy options, and it really comes down to the fact that the payoff graph that you see on your screen, the ability to have unlimited upside if you're right on the directional view with limited risk, on paper sounds very attractive, right? Who wouldn't want to leverage their capital 25-1, control a $100 stock with just $4 or $5, and at the same time limit their risk so that even if the stock goes down to zero, their risk is limited to that, just 4 to 5% of the underlying stock. And this is the part that I think traps a lot of beginner investors who start looking at options as saying, oh, instead of risking $100 a share buying the stock, let me risk only $4 or $5 a share buying the option. But the trade-off that you're making with this fairly attractive risk to reward ratio is the fact that, as Chris said, not only do you have to get the direction right, you have to get the timing right, because you have to get the move before the expiration of the option, and it has to be, as Chris refers to, the amplitude, or what I call magnitude, because it has to be a large enough move in the direction that you expect. It's not just a view. It's not just a directional view. You have to get the directional view strong enough in order for it to be profitable. And those three things, to get those three things to line up, doesn't happen all the time. So that's really why, I think it's really important for us to just reiterate and go back to that. Most professional investors rarely go out there and buy call options. Instead, what they typically do is look at option selling strategies. And many times, this is the strategy where your potential reward is limited and your potential risk is unlimited, right? So a short call looks like this, where the most you can make, if I sold that $4 call option, the most I can make is $4. And my risk is theoretically unlimited. And many investors, when they look at this type of risk to reward ratio, it doesn't make any sense. Why would I ever want to take on just $4 worth of potential reward in exchange for unlimited risk if we're selling a naked call or a naked put? But that's really why we start off with selling covered calls first, so that you don't have that unlimited risk. But when you start selling cash secured puts, let's talk a little bit about the benefits of this strategy, because from my perspective, This is where you don't have to necessarily get the timing right. You can actually be wrong on the direction and still be profitable on the trade. And that's why professional investors prefer selling options rather than buying options. So Chris, why don't you talk a little bit about, how you use option selling strategies in your practice?
Yeah, so if we're using this example here of covered calls, the one thing that I like people to use is, using that portfolio approach. So you're using this covered call strategy as, a way of enhancing income or enhancing return alongside a long only strategy. And so, the nice thing with covered calls, they can be done in an RSP, they can be done in a TFSA. They're really simple and they really don't add risk to a portfolio. You're just saying you're selling somebody your potential upside. The other thing is, I think it's important to make sure you don't just do it on one stock. If there will be times where you've got a stock, it's $50, you sell that $55 call and the thing goes to $90. And, that can be very frustrating. And you think, I'm the worst investor in the world. Why did I do that? But it's really the repetitive nature of doing it over and over that makes this strategy work. And it's the fact that if you have one stock that runs away on you in a portfolio, you've got 5 other ones that you sold calls that the stock didn't run away. So you've got all of that other premium to add to your overall return. As well, I think you want to make sure you've got, I see you've got on here sort of 45 to 60 days to expiration. I think you want to have a mix. If you're selling calls on a utility, implied vols are going to be lower. You're going to probably want to go out a little bit longer. And then you've got some more high flying, higher implied vol names, then you can maybe have that timeline shorter. I think the one thing you want to try to really make sure that you stay away from in these is make sure you don't have everything expiring in the same month. You don't want to find yourself, market really rallies and now you have no stocks left, or, if we're doing a put selling strategy and the market really declines, and now all of a sudden you're strapping on a whole bunch of stock that you maybe didn't want to have all of that in your portfolio at once. So when the market really whipsaws, I think what we saw last March is an example. The market really went down and then went right back up. If everybody had sold April calls, they would probably found themselves in the end of April regretting putting those trades in. So I think you want to make sure you've got a diversified mix that you're selling on with a mix of timelines and then a mix of expirations.
So I'm glad that you talked a little bit about those best practices, because I think that's exactly the type of insights our viewers are looking for. Can you talk a little bit about how do you choose your strike prices on a cover call? Because I think this is a topic that many investors are interested in.
Yeah, so in an ideal world, we've got target prices on stocks and you can just look at the market and see, okay, we've got a $70 target on this, so I'll sell the $70 call. I think that is a good strategy. If you're following an analyst or you've set targets for yourself to try to sell strikes at that target price, I think that in investing and in research, there's definitely a tendency by people to fall in love with a name. And, you put a $70 target on stock XYZ and it goes to $70. So, technically you should sell it according to your target price, but most people just raise that target. Whereas if you sell that call option, it can force you to stay within your parameters there. So again, I think, I'm not trying to water this down, but you want to have a bit of a mix. You want to have some names where you think they're fully valued. So you're selling a call that's near the money. And then you've got some that you think that there's a lot more run room between where the stock is currently trading and where you want to set those strikes. So at the risk of repeating myself and sounding like I don't want to give an answer, I think you want to have a diverse mix and just, it all relates to where you are comfortable owning that stock. If the stock is here and, if it goes up 10%, you think it's fully valued, then, I don't think you should set your strike any higher than that.
I think that's very good advice, because, when we refer to 45 to 60 days and using about a 15 to 25 delta, that's using more of a quantitative approach to selecting your quote unquote optimal strike price using back tested strategies, which strike price gives you the optimal return while limiting or reducing the number of trades where your stock gets called away. But as Chris says, when it really comes down to the process of actually applying covered calls for your portfolio, each holding is going to be different. And you're likely going to have slightly different parameters for each one, depending on whether it's more of a boring utility stock or more of a high beta tech stock. You might adjust your expiration dates accordingly. And then depending on whether you are close to your target price or whether you're still quite a bit far away from your target price, that might go into adjusting your strike price. And I think that's really important for us to discuss. And Chris, do you have any best practices around, if let's say it's a stock that you don't want called away, that you want to continue owning that stock, what best practices do you generally have to kind of help you avoid having that stock being called away?
Yeah, so that's going to happen to everybody. I think one thing you'll find is that often the day you sell that option, you're comfortable with it being called away. And then once it starts rallying and you see the rest of the market is seeing what you saw in that stock originally, that's when the regret will start to come in. And so I think trying to stay disciplined is one. If it's like, look, if I decided on March 10th that I was okay selling this stock at X, if it goes to X, I shouldn't change that. But if something does change, you can always be looking at rolling options. So that's a huge thing where we're going to be buying back that option that we're short and then selling the same strike option, or I guess you can change the strike option. If you're rolling it in the money option, in my practice, we'll find that it ends up being the same strike. So often you want to be putting that in, especially on less liquid names, you want to be putting that in as a calendar spread so that both sides of that trade are going to execute at the same time. I'm sure you've had this happen to you in the past, Tony, as any experienced option trader has, where you've gotten half of your spread trade filled because you didn't put it in as a spread, and there is no more naked feeling than trying to buy back that option or sell that other side of that, and you just can't get a fill from a market maker. And then if you've got something in the money and you've decided, look, I actually don't want to be getting called away on this, you can kick the can down the road a little bit, generate some additional premium by rolling that out by 1 month, 2 months, whatever makes sense. Just make sure that if you're doing that, you're entering it as a calendar spread so that you don't get burned.
Right. And this is something that you and I discussed a little bit before this call, and you have a different philosophy on this than I do. I generally avoid selling calls going into earnings. You tend to favor the opposite side. I'd love to hear a little bit as to why.
Yeah, hey, that's what makes a market, right? Is different views on stuff. It's my view on this is, I'm only going to be selling covered calls on stocks that I'm comfortable owning with the information that I've got today. It tends to be in the overall market that stocks that have more uncertainty surrounding them will have a higher implied volatility because you've got more people wanting to buy options that are either going to make money if the stock goes way up or goes way down. Either way, it's going to expand the implied volatility on the options. And so if you've got the uncertainty of an earnings call that's happening between now and the expiration of that option, you tend to see a bit of a higher implied volatility because, what is going to be in that report? Well, I don't know, and neither does anybody else. So option prices can go a little bit higher. And so that's where I tend to, take the opposite approach and try to sell straddling an earnings.
Well, I appreciate you providing your insights on that. So with that covers what Chris and I wanted to share with you here today with respect to, where we currently see the broader markets and just a discussion around how we utilize options in our portfolio. So at this point, what I'll do is I want to open this up for Q&A. I want to provide our viewers an opportunity to ask Chris and I any questions that you have regarding the discussion points that we talked about regarding options. I already see quite a few questions here and I'll try to go through them. But if everyone, you have both a chat window and a Q&A window here at the bottom of your screen. If you can bring up your Q&A window here at the bottom, Please type your questions into the Q&A window, and Chris and I will take some time and answer your questions out of that Q&A window. Chris, there was one question that I thought was quite good from Keith. He asked this earlier. And as a practitioner in Canada, myself being a US resident, I can't trade US options. I'm quite familiar with some of the challenges that many investors talk about with trading Canadian options, but I think as a trader yourself, you're probably better suited to answering this question. But Keith's question is really, as an active options trader in the Canadian market, I am often dismayed at the bid-ask spread, or the difference in volatility on the bid-ask. How to best set up either a credit or debit vertical without paying too much to the market maker. So I'd love to hear your thoughts around, when you're selling a cover call on a name that may not be in the top 5 or top 10, and from a liquidity perspective, and you might see a spread that's perhaps 20, 30, 40 cents wide. How do you go about placing your orders, or how do you go about thinking through whether this is a stock that you might want to sell a cover call on?
Yeah, so I guess first, if the liquidity is not there, then it's not there. I mean, you can't always force liquidity. I think that what you'll find is, in this, is when there is truly limited liquidity on the options, it's often because there's limited liquidity on the stock as well. So I think that sometimes people will talk about how, the Canadian options market, there's no liquidity. I think sometimes people are choosing stocks that there's not much liquidity on the stock either. So if there was that same amount of liquidity and the stock was trading on the NASDAQ, if you opened up a CBOE options chain on that same stock, or found an equivalent stock in the US with the same amount of liquidity on the equity, the options would have the same thing. So ways that I will try to combat this a little bit. So one, obviously, pick the price that I think is fair, where I think that I'm comfortable getting filled. So, if the bid's 90 cents and the offer's $1.30, and I can right away say the midpoint's $1.10, well, okay, I'm okay giving the market maker a nickel. I'll go in at $1.05. This totally just as an example. So definitely when the spreads are wide, I'm not going to be hitting the bid. I'm not going to be just saying, market maker, please, I'd like you to have this money instead of myself or my client. So going to be just picking your point, usually near the midpoint, where I'm comfortable doing it. Once you have an option that is out there and is nearing expiry, now you can start to use spreads. And so now you're actually speaking more directly to the market maker. So even in a situation where you've got an option that's expiring out of the money, rather than letting it expire worthless, you can put that in as a calendar spread where you're going to be buying that back and then selling a new option out to that new month, and put in your desired credit. And that's either going to fill or it's not. And so this is an area where you don't have to be playing a bunch of guesswork with the market or watching if the stock's moving higher or lower. When you put that out as a calendar spread and say, okay, I'm willing to buy this back and sell this new option, and I want 85 cents as my credit, it doesn't matter to you if you pay $1 for the one you're buying back, as long as you get $1.85 for the other one, or if you pay $100, as long as the trades will not go through unless both sides are going to fill. So that's where using spread orders, you can do those in Canada. And I feel like that's a way where you're speaking a little bit more directly to the market maker and can sometimes often get better fills than if you're just sitting out there with 5 contracts to sell something. So that would be a way. And then I guess the other side of it, is there's a lot of the Canadian stocks that are larger cap stocks, they are interlisted. So, if you're trying to sell a covered call on Royal Bank and you're not satisfied with what's happening in Montreal, you can sell it in the US as well. And your obligations are the same. So you'll just get called away on that stock, just like you would if you sold it in Canada. So those are kind of the alternatives.
Yeah, I think this is a really important discussion. And I just want to go back to your example. If you're looking at an option that's trading at 90 cents by $1.30, right? So you have a bid of 90 cents. You have an ask of $1.30. You can think of the bid ask price as kind of like the sticker price that you see on a window when you walk onto a car dealership, right? And just like when you walk onto a car dealership, you never try to pay the sticker price on that car dealership. The difference between a car dealership is that if a car on the dealership lot is offered at $30,000, you don't really know how much the car dealership paid for that car. So you're kind of negotiating in the dark. The great thing about an options market, it's a two-sided market. You have a sticker price on both sides. You have 90 cents on one side, $1.30 on the other side. And what Chris was referring to is the midpoint. The midpoint is what you can use as a gauge for what is roughly the fair value of an option. And that's really where you start your negotiations. So if you're trying to buy something, you're going to have to pay a bit of a markup above the fair value, because no market maker is going to sell to you at fair value, or else they can't make any money. So you have to bid your way up, maybe $1.15 as Chris was saying. He might pay an extra nickel on top of the fair value and see if the market maker is willing to play ball. And if he's selling, he'll take off a nickel and maybe try to sell at $1.05. So this is really, it doesn't matter how wide the spreads are. And again, I know that in Canada, some things have wider spreads, but that's just really a factor of how often the option trades. If the stock is liquid, you don't really have to be too worried that much about how wide the spreads are, because you can negotiate. That's the great thing about a market. And there's nothing stopping you from continuously negotiating until you get a price, or until you get a price fill that you're satisfied with. And if you're not satisfied, if you don't get a fill, you can walk away. That's the great thing about placing a limit order, is you're effectively negotiating and seeing if the market makers play ball.
Yeah, I'd add to that just what you said, how, if the spread is wide, but it's on a really liquid stock, that a market maker is going to be able to hedge themselves very easily. So don't be fooled by the wide bid and ask. You can hang around the midpoint. But don't be surprised if a stock is trading 25,000 shares a day, and the spread is wide, and you're looking at your screen and you're saying, this is outrageous. Why is the market maker filling me on my 50 contracts? Like, they literally cannot hedge themselves because there's not enough liquidity on the stock. So I don't think that's the options market's fault on that one. The other one with this is, for us, being professional traders and having, we've got a trade desk where I've got traders who are connected with the market who can, work these orders up and down if we need to try to get a fill. So I guess that's a plug.
And I'll just have one, I'll do a little plug here, Chris, myself. If you have options play, there is a link at the bottom of your options play tool, which is called Liquidity. And we do this scan every single day, twice a day, where we look at the bid ask spreads of the full options chain on all 300 or so optionable symbols in Canada. And we look at the size of the spread, we look at open interest, and we look at volume. These are the things that we use to determine liquidity. So we basically rank every single optionable stock in Canada based on liquidity. So for those of you that are asking, how do I know which symbols are liquid? Well, right now we have about 83 symbols that we would consider very liquid in Canada. We have about 200 or so somewhat, about 120 somewhat liquid symbols. Anything outside of that we consider not liquid. So we generally wouldn't trade anything outside of this list. So this is a list that you have access to as part of your Options Play platform. Most of you here are familiar with Options Play, but if you don't have access to Options Play, you can register for free at optionsplay.com/TMX, which I will post into the chat window. So because liquidity is something that a lot of you guys ask about. So I hope that this liquidity spreadsheet that we calculate every single day is helpful in giving you a better understanding as to where you might want to look for some names. Okay, let's see. Just looking at some questions here, Chris. Edmund saying, thanks for the great presentation, Chris and Tony. Chris referred to taking an upside option position with an option sale, would sell two puts against one long call. I think you were referring to two calls against a long call, right, Chris?
Yeah, so looking at, I guess, the 1x2 call spread, or also known as a levered overwrite. So that would be a situation where I'm long the stock, okay, and let's say it's either approaching my target price, or maybe I bought it and it immediately went down and I just want to get out for what I paid, or something. I'm long the stock, say I've got 100 shares. I buy an at the money call option, and I pay something for that. And then I sell 2 higher strike calls against that to pay for the option. So effectively, there's a couple ways of looking at it. I've got a covered call trade on, where I've got my long stock and I've sold a call against it, and then I'm long a call spread. Or you can take a look at it just as well, actually, I'm kind of rambling here. That's sort of the best way to look at it. You're long a covered call and a call spread. And I try to do that without spending any money. I try to do it for either a net credit or for even money. Because then if I'm wrong, all the options expire worthless. No harm, no foul for me. I can just look to do it again. And then eventually, and so what that will do is it will give you 2-to-1 upside within a window. And then your upside is capped.
Yeah, so that's exactly what I have here. Just for example, I'm long 100 shares of XIU. I've bought the May $28 call, which is the at the money call, and I've sold 2 contracts of the 29.5 calls. Now, this isn't a net zero here in this particular case, but it's the same kind of trade here, where basically what he's saying is that he has 2x between 28 and 29.5, and he gives up his upside above 29.5 in exchange for that 2x. And the downside is the same as if he just owns the stock, especially if he's able to trade this at a net credit, or a net zero, if you will, on this particular trade. It's the same as a repair strategy, as some users will refer to, is when you're down maybe 10% on a stock, you buy a call option and you sell a cover call at your original cost basis, or 2 contracts your original cost basis, as a quote unquote repair strategy, giving you that 2-to-1 ratio up to that halfway break even point. So it's a similar strategy that you can utilize. It's an interesting way to play for a short-term upside that's levered, while not experiencing any additional levered downside if the trade just goes south.
Yeah, I think that's a good explanation.
Can you speak to what you look for in technical analysis before executing a cover call? Now, Chris, I'm not sure, do you use technical analysis in your cover calls? I can speak to this a little bit, if technical analysis is not something that you use heavily in your practice.
Yeah, I'm comfortable sending that to you. We're definitely more fundamental.
Yeah, so I mean, as far as technicals perspective,
that we're doing, yeah, go for it.
Yeah, so on the technical side, I would say that, I would only use technical analysis in executing a cover call if my original stock position was executed as a result of a technical view on the stock itself. So for example, only if, let's say, I was buying the stock because of a technical breakout, then would I use technical analysis to determine the strike prices on my cover call, because I would use a technical analysis to gain that target price. So Chris uses fundamental analysis for his target price. You could potentially use technical analysis for your target price, but that's only if you're owning your stock as a result of a technical reason, if you will. So otherwise, I would use just general best practices of using a probability-based approach to selecting your strike prices. That's why we use a 15 to 25 delta, something that has about a 15 to 25% chance of the stock being above the strike price at expiration. That's why we use delta, so that we are always using a consistent approach to selecting our strike prices. Let's see.
I can see one question here regarding rolling a covered call. I think I can speak to that. So the question is, when you roll over an option, a covered call, do you still get to keep the original premium? So the answer is yes. That money, when you sell a call option, that money is yours to keep no matter what happens. And so let's say I sell it for $1, and at the end it's 50 cents in the money, and we're at expiration. I'm going to be buying that back. There's no time left, so there should be little to no time value left. So if it's 50 cents in the money, I should be able to buy that back for pretty close to 50 cents. But but the original premium that I collected is mine. So even if now I sold it for $1, but that stock is $1.50 in the money, I'm gonna have to pay $1.50, which is 50 cents more than what I originally sold that option for. So I'm paying more than I originally collected. But because I'm gonna be rolling that, if it's $1.50 in the money, the one that I'm selling is gonna be higher than that $1.50. So you will or should always, if you're entering the trades properly and doing it as a spread order, always generate a further credit when you are rolling those options if you're sticking with that same strike. So yes, the answer is you do get to keep that premium. You may have to pay more or less to buy that option back, but no matter what, you should always be collecting more premium for the new option that you're using to replace the one that you're buying back.
Right, exactly. And that is kind of what Ken was asking, is just, can you please explain again the cover call, when you're rolling your cover call as a calendar spread? Could you just talk a little bit about that calendar spread part, just for viewers who may not be as familiar with the calendar spread?
Yeah, so I'll do it as quick as I can. I've got a whole half-hour presentation on how to roll options, so I'll try to push that down into about 30 seconds. But basically, a calendar spread is where you're buying or selling an option in 1 month and buying or selling an option in either the same or a different strike on the same stock in a different month. So the thing is, when you enter something as a spread order, either everything fills or nothing fills. So let's just say I've sold a covered call on XYZ. I've sold a $50 call and the stock is trading at $50.50. So it's in the money. So if I don't do anything, I'm going to get called away on that covered call. So I see, okay, it's 50 cents in the money. It's option expiry day. So that option should be trading around 50 cents. And so this is March. So I look out to May, and that same $50 call option, because there's a bunch of time, is trading at $2.50. Just again, totally as a random example. So I'm going to enter that order as a calendar spread, which is a buy to close, the March option, and sell to open, a covered $50 call out to May. And I'm putting those in as a spread for a $2 credit. So I actually enter that trade as one, the two parts as one, and all I actually input is what I want for a credit. So now that order goes out to market makers, and I said, when you're putting these things in as spreads, it's almost like you're talking to the market maker rather than just, putting out a random bid or ask. You're saying, look, here's the business that I want to do with you, market maker. I want to buy this and sell this, and I want $2. And then either both sides are going to fill or they're not going to fill at all. And so you can actually change that credit, if it's not filling to $1.99 or $1.98, you can actually, in some cases on stocks that the options only trade in nickels, like 5-cent increments, you can actually put these things in and say, well, I want $1.97 as a credit, and it will trade in pennies because the market maker is transacting on both sides of those. So the calendar spread is something that is a very, very important tool for people who are rolling options. A, because you won't get stuck with just one side of the order filled. But B, you're not actually gonna have to pay that market maker twice. So let's say you did it as two parts and you're trying to you find the midpoint for the one you're buying and the one you're selling, and you got to give the market maker something on both of those trades. Here, you can actually split the difference in many times because the market maker doesn't need to make quite as much on the overall spread trade. So
I think that's fantastic insight, especially for those of you that sell cover calls. Understanding how these roles work, because a lot of investors get confused about the term roll. The roll, you don't have to be scared by a roll. The roll is just simply closing out your existing cover call and selling a new cover call, but doing that in one order. And because you're basically transacting across two expirations, that's why it's called the calendar or diagonal, depending on if it's the same strike or not. But it's really just transacting across closing out your current position and establishing a new cover call in a single order. And that allows, and there are efficiencies to doing that rather than placing two separate orders, one to buy and then one to sell at a later time.
So yeah, so this is one, again, not trying to sneak in too many plugs here, but oftentimes on a discount brokerage, what can be seen out there is that if you're not entering these things in calendar spreads, it's great when you're paying $6.99 a trade or whatever it is, but then there's those hidden costs where if you're actually paying a market maker to transact with you because you're not getting the best fill on these spreads. So that's an area that as a portfolio manager, again, with our trade desk and with the fact that we're doing this all day, we can often get better fill prices when we're entering these things as spreads than a person would be able to do if they're putting it in as two parts.
Fantastic. So with that, Chris, what I'll do is I'll wrap this up by just giving you an opportunity just to reiterate how investors here on today can get in touch with you if they're interested in the services that you offer at your firm.
Yeah, so everybody's got my email and phone number there. Really, I mentioned how I'm just always trying to simplify options trading, always looking to expand my network of options traders in Canada. I feel like as people interested in options, we're a bit more of a community than just overall market participants. So, always happy to hear from people. I have done a number of presentations throughout the last year and continuing to do them just like this. So if you're interested in attending some of those or having attended them in the past, please reach out to me. Always happy to hear from people. And then, in the past, a lot of people who have started to work with me are the people who have been trading options on their own for a long time. It either has become a bit too onerous or it has, they've had a big trading error or something like that, and they just want to have somebody to help them with the execution and make sure that somebody's working it at all times. So happy to have any kind of those discussions. Anybody in the options community is always welcome to give me a shout.
Well, thank you so much for your time here, Chris, today. And for those of you that want to take a look at Options Play, many of you already have access to this, but if you don't already, you could register for a free account at optionsplay.com/TMX, which I'll post a link into the chat window. And just one last point, again, if you're interested in a liquidity list, it is at the bottom of your Options Play platform. There's a link, and when you click on it, it is a report that we generate on a daily basis to let you know which symbols are very liquid within the Canadian options. And we actually list them from most liquid to least liquid based on the size of the bid-ask spread. So the ones at the top of the list are the ones with the least or the smallest bid-ask spreads with any names that you're trading. So with that, Chris, thank you so much for your time this afternoon. If there are anything, any closing statements before we close here for today?
No, I think that's it. Always happy to do these presentations. I enjoyed it. Thanks, Tony. And yeah, look forward to doing it again down the line.
Yeah, thank you so much. And I really appreciate your insights and just the perspective that you bring as a practitioner of this on the institutional side, giving that advice to individual investors as to how you deal with wider spreads, how you deal with, thinking about expiration dates and strike prices on cover calls. I think that's exactly what our viewers are looking for. So for those of you that are here on the session, we will send out the recording to you guys as soon as we finish processing this in about an hour. We'll send you both the slides and the recording, and it will include Chris's contact information if you'd like to get in touch with him. So thank you so much. I hope you guys have a great trading day and see you guys here in about a couple of weeks.
Thank you.